Hello, ladies and gentlemen. It's Wednesday, ibmtv investment show with Sasha, and I'd like to introduce my guest. It's our man in Washington, Bill Tresvant, our political commentator and legal mind. And also, I'd like to introduce Shaquille Latimer, who is managing uh, billion plus funds in everywhere around the world, including Switzerland, Liechtenstein, and many, many other countries. How are you today, my friends?
How are you?
Good, good. Of course, I can't avoid it. It's investment show, but we can't skip the question regarding yesterday's debate of incumbent President Donald Trump and the former Vice President uh, Joe Biden. And I'd like to have your take. How you see it and what it will do with our investments policies and what's the best way to deal with that.
Okay, well, to summarize the debate, it was a play school. I think generally everybody was completely disappointed with the nature, the quality, and the tone of the debate. I think it's unanimous that it could have been better. I think that at this point, people are going to take sides and blame who they think is, responsible for it. Some will argue that Trump began and instigated the entire tone and mudslinging. Others will say Joe Biden was no better because he was responding. In any event, what it didn't do is it did not provide us any kind of clear information on the candidates' respective policies. And for purposes of this show, with regard to their economic plans, either post-pandemic or even dealing with COVID, because I think everybody commonly agrees that we can't fix the economy until we fix the COVID problem. And then there's a question of fixing our economy. And then after that, there's a question of what we do with global trade negotiations and partnerships and deals around the globe. Now, that having been said, at least what I can offer for your audience is this, is that it seems to me, and then I do have a question, Sasha, for both you and Shaquille. It seems to me that the answers coming from Washington are few and far between, except this one loud clarion call, and that is that there's going to be uncertainty, massive uncertainty and instability. And just to point out a couple of things of where we stand today. One, the government runs out of money as of midnight tonight, and there is still no funding, continuing resolution that has been signed by the president. He's off in Minnesota right now. So the government could run out of money at midnight. That's one. Two, tomorrow, the federal bailout for the airline industry ends, which means 40,000 plus airline employees are going to be out of work. Next, Disney is laying off a quarter of its worldwide staff from 28,000 people here in the U.S. alone, both in California and Florida. And then we've got various other things. The Dutch Shell Company in London has announced that they're going to be laying people off anywhere from 7,000 to 9,000 over the next few years as a result of the decrease in the demand for oil, as well as the slide of the price of oil because of the COVID impact. And then there are various other magazines that are laying people off on a mass scale. And on top of all of that, there is still no sight of a federal, that is an American federal COVID relief package. And Congress adjourns as of Friday. Now, what occurs to me, Sasha, is that for purposes of this show, with all of that instability and lack of direction coming from the federal government, what should they be doing? And I've heard about a couple of different things, at least that have become significant trends in the market. And one is an increase in the activity of mergers and acquisitions. And I didn't know if that was a result of people taking advantage of lowered expectations, lowered prices, and consolidating for the long run. And another thing is that there's been an uptick in the offering of direct offerings to the stock market, bypassing the normal IPOs. And then one more thing, because the extent of the uncertainty right now coming from lack of direction of the federal government, there have also been a number of reports from the various central banks around the globe where it seems as if they were making pronouncements about the economies, their respective zones of influence. They were tentative in the sense that they said, well, we think the economy is slightly recovering and it's okay, but we remain worried about, and then they list off significant factors. And does that mean that they're really covering up and that we don't know that the economy is worse off than what they're saying? And what does that mean for your investors? So, Sasha, I know it's a lot, but I can tell
Well,
you.
it's a loaded question, which is I've heard about 6 or 7 different questions into that one. Let's start with first. You're saying U.S. Government tonight running out of money.
Yeah.
Well, I was thinking about that, and I have a little bit here that I could possibly help.
Okay.
Not much, but still, and also, of course, you have our Canadian dollars too. Well, it may not be great help, I mean, but if we all try to pitch in and help, that may work out. Yeah. Okay. Shaquille, maybe you'll tell us about central banks who are saying that the economy is recovering, and what's your take on it? I mean, I'm not really knowledgeable that much about the central banks and what they're saying. I mean, they should say that the economy is recovering, because if they will not say that, then there will be a run on a bank, and depositors will ask for their money, and it will be the end of the banks as we know it. So, what's your take, Shaquille?
Well, firstly, can I just say, as a person who believes in republicanism, not republics versus Democrats, republicanism, as in I think that a country should have its own national sovereignty. Thank goodness the Queen has her face on Canadian money, because she's done so much for Canada, right? It's like in Australia, she's got her face on the back of every coin. And on our $5 note, you guys actually elevated to a 20. So yeah, thank goodness for the Queen. I'll leave her. Back to the central banks. Look, it's a very interesting scenario actually. I'm looking at the markets today. The 10-year notes, or certainly the December futures on 10-year notes, are actually down 10 points. So that means that bond yields have just increased slightly. We can talk about the debate in a little bit more detail if you like, Bill. I'd certainly love to do that. But just in relation to how the debates affected the market, if at all, I don't know if there's a clear winner. I don't think there was a winner at all. I think it was a loser, and the loser was the American people that had to put up with that nonsense today or yesterday, and the rest of the world that's trying to see what's going to happen in the US. I think that was a disgraceful performance by both sides. But in any case, bond yields are down. Bond prices are down, so yields are up. We've seen some of the tech stocks move up on the open, and actually in the pre-open as well. If we think about things like Apple stock, it's up a little bit. The VIX index, which is a very interesting one. So for those of you that don't know what the VIX is, that measures the volatility and the uncertainty, I guess, within the market. So the higher that goes, the more uncertain things are. And the VIX actually came down almost 4% already. So that's an interesting scenario. It's almost like the market sort of priced in that the debates were going to be a complete debacle, and having delivered a complete debacle, they stabilised. I don't really know how to explain it. And that's really the thing with this market. It's very, very hard to really assess what's going to happen based on a political result. I think outside of COVID, you would generally assume that under the Democrats, with higher taxes and more focus on social, social issues and funding education, healthcare, those sorts of things, that may have a dampening effect on the market longer term over the next presidency. And under the Republicans, generally will have a more buoyant term because they'll cut social services. But this is different, I think. I don't think it's very easy to assess that because you actually have this external thing going on, which is COVID. And as I said in previous shows, the whole world is subject to that. To get back to your question, Bill, I think you make some very valid points. You talked about mergers and acquisitions. You talked about IPOs. Look, I think for most people who are trading or who are looking to trade based on what they're hoping to do, like hoping to maybe make a little bit of extra income or, try to sort of increase their assets through retirement, those sorts of things. I think this would be a very difficult market to play in. The big boys can come in and do a few things, but as an at-home trader, I think you'd have to be very, very careful. And I would suggest, I would strongly suggest, without giving any financial advice, that people look at more market neutral type strategies, as I've said many times before. They don't have to be complicated. A lot of people think that market neutral strategies are complicated. They're really not that complicated. And I think that people would be much better served by trading in a market neutral way rather than trying to pick an individual stock and say, okay, that stock's going to go up or that stock's going to go down. Unless you are able to withstand some volatility in your trading count, withstand some drawdowns. If you're using covered calls like Sasha often talks about, if you can withstand the drawdowns in your account, fair enough. But if you are going to look at this as being a major part or even just a significant part of your future income, I think you'd have to be a little bit careful with this market because it's a tough one.
Okay. Agree with you, Shkil. Now, speaking about to look at the market today, I'm under impression that today is the last day of the month and the last day of the quarter, third quarter. And I think there is a certain dressing up going on. The quarter was horrible. And so today's the last day when...
Yeah, and wouldn't that...
Have we just lost Sasha? I'm here. We lost Sasha?
I think we may have. But here, let me ask you, because I think where Sasha's going, well, he may not, I don't know where he's going. But let me try this, that if it's the last day of the quarter, and the quarter's been particularly rough, and this is the last day of trading, wouldn't there be pressure on profit taking right now to try to gain what you can so that you can at least have a decent quarter rather than a loss? Is that part of the thought process on the last day of the last quarter?
Yeah, possibly. But when you say is that part of the thought process, the thought process for whom? For professional money managers, for banks, for at-home investors? Who are we talking about? But if you are talking about where the professional money and what the professional money is doing, one of the problems that professional money has, and again, professional money has all sorts of different areas. Like my kind of fund's global macro. As an absolute return, I've got a lot of flexibility. I can put money, I can move money straight out of the United States and move it into South African futures if I want to. I don't have the same sort of restrictions. But if I was running a pension fund, I might be mandated to always have my money in stocks. So there is a type of thing called sector rotation, which is where people might move their, professional money managers might move their money from the market into, say, commodity prices. Natural gas was at very, very low prices for a big part of this year, 3 or 4 months of this year. They were actually at very, very subdued prices. That's happened before. Oil, as we know, has been at very, very subdued prices. In fact, at some point, some of the futures were trading negative, which meant that you actually got paid to buy the oil. And so there's a lot of places where I think professional money managers will look at saying, okay, well, how about we move out of stocks and move into commodities, or let's move into interest rates, or whatever the case may be. But yeah, taking profits in this quarter, the big question is going to be, what do you do with the money once you've got it? Because as a professional money manager, you have to do something. Very few managers can just sit on cash.
Okay. Well, that's with that segment of the investment market. What are your thoughts about how the individual investor and our audience might think about if they're just trading for themselves, or they have a smaller position? Would you suggest that they take profits and then sit on the sideline given the uncertainty, or would you just say, how would you go about kind of thinking about it again?
Look, I think that what you would do. Sorry, Bill, I didn't mean to cut you off. Sorry.
No, go right ahead, Bill.
I think what you would be looking at doing, what I would be saying to anybody who's sitting at home is, don't feel overwhelmed by all the different theories and all the different knowledge that's out there. Mm-hmm. Okay. You don't need to know how to drive a road train in order to be comfortable and confident when you're driving a car, right? So you don't need to know how to double clutch and how to change 18 gears to drive an automatic Hyundai. Okay. So I would just say to people, learn about how some instruments work that are available to you through most standard retail brokerage accounts. So learn about options and how you can use them, and learn about futures contracts if you want to, but certainly start with options and just learn a little bit about how those actually work and how those actually operate, because a lot of people get the impression that options, for example, can be very risky, and they are correct. They can be very risky, but the other side of why options were created, and futures contracts actually, was to hedge risk. So if you use options the right way, they can actually make an existing investment less risky. And what they can do is they can help protect you against a bad move against you. So that's what I'll be looking at. I think that the everyday at-home investor who's just starting out wants to be very, very careful about trying to guess market direction, either in general over the whole market or on individual stocks, because if you've only got $10,000 in your account, you don't want to take a 30% drawdown. Right. If you take a 50% drawdown, you lose half your money. You're going to need to double your account just to break even.
Okay.
So you've got to be very careful about that.
Okay, well then let me ask you this: for our audience, given the uncertainty that is in the foreseeable future here in the American economy, and the ripple effects, because there's certainly uncertainty in Great Britain because Brexit is still hanging out there. There is uncertainty with other countries in terms of their economies. Some are showing improvement, others are I wouldn't say stagnant, but they are just kind of limping along. And that's going to be for the foreseeable future, clearly linked to this COVID pandemic. Should these investors should people be looking to, put their money into less risky assets and kind of save for the future? And by extension, and when I began, I asked, is that the reason we're seeing an uptick by companies in mergers and acquisitions? Because maybe they're sitting on cash and then they're trying to consolidate in their area so that they are in a better position to compete for the future. What are your thoughts on that, Shaquille?
Look, that's a possibility, but mergers and acquisitions, I'm not sure that that's going to be something that the everyday person at home can really play in that realm.
Okay.
And I wouldn't advise it either. A lot of people, they do a thing like buy the rumor, sell the fact. So if they think a company is going to be, taken over or might be a merger and acquisitions prospect, then they buy the stock in anticipation of that. And then once it happens, they sell. Or once an announcement's made, they sell. I don't really think that the everyday person should be trying to play in that realm, because it can be risky as well. And, how are they going to really know what's going on unless they have a lot of knowledge about a certain area of the market? But yeah, to get back to, I think your more fundamental question, which was, should at-home investors move into something less risky? Such as what? I mean, that's the big problem.
What about gold?
Well, I don't necessarily think that gold's less risky. Gold is considered a safe haven asset.
Yeah.
The problem with that theory is if you go to gold right now in order to be a safe haven asset, it's a safe haven asset while the markets aren't performing too well, or whilst there is, the idea that there could be a collapse in the stock market or even a collapse in the currency. But as soon as things stabilize, gold prices relative to US dollars is going to drop quite significantly. And look, we saw that back in 2008. After 2008 occurred, gold hit, I can't remember exactly the high, but it was around the sort of 1800 mark. And it dropped all the way down to 1200, I think it was. So that's a pretty big difference, in your investment. So, the other place that a lot of people would do, and look, I was at the bank here in Australia just the other day, and I saw actually quite a few people who were a little bit older, and my heart really went out to them. They came in and they needed to roll over their term deposits. And the bank said, okay, well, look, the rate is 0.55%, but right now, you get a bonus and it's 0.75%. And I just put my hand like this, and I thought, my goodness, because if you happen to have $300,000 in your retirement account, 0.75% is just over $2,000, whereas years ago you're getting 4,000 for 4%, so you're getting $12,000, and $12,000 is $200 a week, $240 a week. Big difference between $240 a week or $12,000 a year and $2,000 a year, $40 a week. I mean, there's a big difference there for people. So that was, I'm not sure that the safe assets have much to offer right now.
Okay.
I think that this is actually part of the reason why we're seeing people improve their homes or perhaps buy investment properties and things like that, even though you're likely to have some displacement of people and some increase in the homeless population. I think that's why, because people are like, okay, well, what should I spend my money on? Why not spend it on improving the value of the house I live in, or buying a new car or something like that, because prices are relatively subdued.
Okay, well then let me ask you about another area, because I think these are areas that members of our audience are looking to, and it's the areas where the market is seeming to increase in activity. And one of the areas, and this is what, and forgive me, and this is entirely due to my lack of an understanding of this area that I'm going to ask you to explain. Obviously, everybody generally knows what an IPO is, an initial public offering. And that is, a company goes to a brokerage firm, the brokerage firm values it, they set a valuation for the company, they come up with a price per share, and then they offer it on the market, and then they appear on the stock market and they offer the shares. Now, there's this other thing called direct issues. I believe they're called direct issues. I think Sasha calls them backroom IPOs. Can you explain to us what these actually are, rather vis-a-vis IPOs?
Look, I think that what Sasha's referring to is more about private capital raisings or pre-IPO raisings. Now, you'll have to forgive me a little bit, because I've obviously never been a broker or a dealer in the United States. So your rules and your listing rules are going to be a little bit different to mine. And this is not actually my area personally of speciality. But generally speaking, what happens with an IPO is that the company will come to or will approach a brokerage firm, or a brokerage firm may approach a company. And that could be a small brokerage firm if it's a small company, or it could be a really big brokerage firm like JP Morgan or Goldman Sachs or Lehman Brothers back in the day, those big investment banks, those big investment firms. And what they would do is they would come up with a valuation of the company, and they would do a roadshow, and they would basically try to raise capital for that company. Shares would be issued with the eventual plan to list that onto the exchange. There are a lot of companies that are a lot smaller that either may not be listed, and so you get like a private offering that's being offered by through your brokerage company. But generally speaking, there's still going to be an anticipation that company will eventually list on the market, or you may actually see things like a private capital raise. So you'll see this with a lot of companies that have very small market capitalizations. You might hear about them called the penny dreadfuls. Some of these companies may have just come off the pink slips in the US. So these are companies companies that may be expanding, but they might have a market capitalization of, I don't know, $20 million. So, it's not going to be a multi-billion-dollar company and something really massive. It's, worth 20 or 30 million, and their stock's listed, but they actually need to do a capital raise. And so the first place they will go to do a capital raise so they can expand is to their existing shareholders. And then they will employ and contract other brokers to try and get some new money in from outside, from investors who aren't existing shareholders.
Okay, and I asked that just to kind of set up, I believe it was on last week's show or the previous show that we were on, where we had the real-time example of Snowflake that was doing its IPO on that day. And at that time, you and Sasha were talking about all the complexities of Snowflake and what investors ought to look for now, and or stay away from, quite frankly. And I guess, right now, is it true? I mean, should they be looking for the same things when you're talking about a direct offering versus, say, an IPO, which is what Snowflake was? Are those the same concerns that you have? Because my concern is this, is that everything else being, and as you kind of indicated, that there may not really be any safe commodities out there that you can kind of go and kind of safeguard the value of your money and stay out of a potentially volatile market and any collapse that may or may not occur. So people will obviously start to look at areas and sometimes beyond their control. And this is another one of those areas, because when you read the Wall Street Journal or the business reports and you see a dramatic jump in this particular area, you're thinking, hey, maybe I can get in there and do something. What are your thoughts on that?
Look, again, I'd like to just remind viewers that were here, I think it was 2 weeks ago now when I did the Snowflake trade. I did it just because, Jimmy and Sasha were talking about it, and I thought, let me just go buy some shares, Jimmy, by mistake, thought that I'd actually said how much money I'd made as opposed to it just being on a private message. But look, I can afford to do that. I know what I'm doing. I kind of know my way around the markets, one would hope. And I can afford to take some risks along the way because, that's not the only thing I've got. I don't really recommend that for people that are just starting out. Not saying that you can't make money, but, you kind of have to stay in your lane a little bit. So although I have pretty good general knowledge over the markets, I have to be very careful about not going into areas that I really don't know. Okay. And so I personally, being a money manager and with billions of dollars committed to me in Singapore and in Liechtenstein, I personally will generally stay away from IPOs unless it's a company where I've had the opportunity to get in the pre-IPO stage, and even then, it would be a very small part of the portfolio. Okay. I might put 1/10 of 1% of what I manage to that particular thing, right? So it's not like it's not like I would go in big. Now I know that a lot of my friends and former colleagues have specialized more in IPOs and they will put more money into it. But I would say to people, look, don't try and reinvent the wheel and don't try to outsmart the market, because there's a lot of smarter money out there. I might be really smart when it comes to interest rate trading and derivatives trading, but you may struggle to compete against me. That doesn't mean that you can't make money. But if you're going to try and outsmart the smart money in IPOs, I would suggest you've got to really know what you're doing. If people are looking for somewhere to place their money, I would very much suggest ETFs as being a great place to look for investments. The reason I say that is because ETFs generally will hold a pretty big portfolio of positions. And there's a lot of different ETFs out there. The CSI 300 is one that a lot of people haven't heard of, but that's the top 300 stocks in China. Okay, the Dow Jones, the S&P 500, the Russell, the NASDAQ, people have heard of them. Obviously, there are ETFs over those. The ASX 200 is more familiar to Australians because you've got the top 200 stocks in Australia, or the ASX 20, the top 20 stocks. New Zealand's got the NZ50, NZX50. So there's a lot of these indexes around that have ETFs, but there's also some ETFs out there that will give people exposure to things that they may not have actually considered, or even if they wanted to access, they wouldn't be able to do it any other way. So, for example, there's a lot of emerging market debt ETFs. These are ETFs that buy a debt in some of the really high-yielding countries. The idea being that, as the economy does better globally, those countries' economies will do better, and you'll realize not just a very nice yield on your money, but you'll also realize some appreciation in the capital you've put in. So there's a lot of different things like that. There are commodity-based ETFs. Sasha a few weeks ago talked about the -2 or -3 bearish S&P 500 ETF. There's all those types of things that people can use, and I'd very, very much suggest that people have a look around there, have a look at the prices today versus the prices historically, have a look at the kind of yield they're getting, and see whether that might fit their, fit their needs. And just again, just in the interest of disclosure, although I do invest in some ETFs, I'm not an ETF provider. I don't get any financial benefit from people investing in ETFs.
Okay, no, and that's excellent. It's important for our audience to know that we come in with unbiased and untainted advice, and so that they can trust what we do here at IBMTV, and particularly on Sasha's show, because Sasha has maintains our high.
I might just add to that very quickly, because I have had a few emails in from people who've seen me on here who've actually asked how they could invest with me. Unfortunately, to the audience, you actually can't invest with me. I'm sorry. I'm basically restricted because of regulations. I am restricted to institutions generally, and to wholesale investors. And even if I wasn't, I wouldn't want most people to invest with me, because the things that I do are complex, and it's important that you actually do understand the risks that are being taken on.
Okay, I guess this, and what I want to do, and I do appreciate that, and that's a very important, note here for our viewers. But I think what I want to do is just kind of take advantage of your brain now that I have it for a moment. May I, Shaquille?
My brain's yours.
I guess what I'm going to ask you is, what do you see short term, and what do you see long term? And by short term, I mean in the next 6 months. And let me just kind of lay out the factors. So we're here in October, November, December, January, February, March. So we're talking until March next year. That would be the short term. And in that time, we'll have whatever the results are of the American election, and whatever controversy short term that is. Presumably, we'll be in a better place where we'll know more about the various vaccine trials that are out there. And my understanding is that there are 35 separate initiatives, separate drugs that are out there, some more promising than others. But by March, we should have a clearer idea. But even still, we won't be able to have a logistical rollout, because that's just too complicated, just given the number of people until like May, June, July. And then it's going to be months thereafter, depending on the population. So 6 months out from now, or in this next frame, what are your thoughts about not just the American economy, but the global economy, or the areas where you see things as potential trouble, things that might be safe, warning signs? And then the same question long term, that would be a year from now. So that would be the following 6 months. Do you feel?
Okay, well, look, I think in the very short term, I know you said 6 months, but just in the very short term, as in from now to the end of the year, I think that the US election is going to be the predominant thing. That is, the US election and COVID, the developments with COVID, are going to be the two predominant things that are going to affect not just the US economy, but the economies of most major countries, especially the UK and most of the economies in Europe. Mm-hmm. That's going to play a big part, because we've heard things like Biden talking about today that he was going to increase the corporate rate tax back up to 28%, which is sort of the halfway mark between where Trump's dropped it to and what the rate used to be at 35. So he's talked about that. So I do think that'll have some effect. But more importantly, actually, than who wins or who loses that, it's how protracted the election result is. If it's a strong result one way or another, that gives a clear indication as to what the policy direction is going to be for the US. But if it's something where it's dragging on for several months, and there's a potential that it might spill over past January 21st, I think that would be unsettling to a lot of people. And I think the market is kind of pricing that in a little bit. There could be there could be a lot of fighting going on between Donald Trump and Biden, and just the Republicans in general, and the Democrats. That instability within the US means it's more difficult then for other countries to work out what their trading relationships are going to be with the US. And the predominant thing there is, of course, we've got the UK. Now, the UK moved politically to the right. Australia moved politically to the right a few years ago. And the US obviously moved politically to the right under Trump. And so with Brexit occurring in January,
Yes.
and UK wanting to enter into a trade agreement with the United States to sort of make up for it not having necessarily a good agreement with Europe as yet, a massive change to government there, plus the distraction of COVID and the distraction of the US needing to focus on its own domestic policies as opposed to its international trading relationships, that could be a little bit unsettling and destabilizing. I think that regardless of who wins, one of the things that was discussed today in the debates was about climate change.
Right.
I personally believe that private enterprise is going to do this themselves better than what government would, but I think you're already seeing that. So you're already seeing that a lot of private companies are focusing in on and trying to support green energy initiatives. We're actually seeing that from companies that a lot of people may not realize or wouldn't think of as being a green company. British Petroleum, BP, as you would know it there.
Right.
BP does invest. They actually had their own brand of solar panels for a period of time. Chevron has been involved in renewable energy. ExxonMobil have been involved in renewable energy projects. Shell, I'm not sure if you get Shell over there, but Shell has been, or Caltex, they've been involved in renewable energy as well, and certainly green energy projects, which would make sense because they're not just oil companies, they're energy companies. And so if they can, try to get into those areas, then that makes sense because it's just a pivot away from what they're already doing. So I certainly think that there's a good potential in green energy under either side, under left or right. Certainly the left of politics may give green energy a boost. So I'll be on the lookout for some of those companies that are potentially going to be investing in, solar farms, wind farms, those sorts of things. Some of them haven't performed that well, but generally speaking, utility companies do.
Okay. Then let me ask you this: when on other shows here at ibmtv, we've talked about what the prognosis was for COVID, and the doctors and the professionals and the subject matter experts would come in, and they say, we are about a year away from having it mass distributed, but there's still maybe confusion about it and such. Now, I guess I'm going to ask you the economic equivalent of that. When do you see the world economies or the world economy starting to stabilize? And we put together, because regardless of who's elected, how long do you see? I mean, we've talked about the short term in terms of what's going to happen, say, between now and up till January. But what do you think? Do you think it's like a year from now? Do you think it's 18 months from now? Or do you think that the economy it'll come back, but it'll be forever damaged and changed? What are your thoughts on that?
Yeah, look, I don't like to use the term forever.
Okay.
I think, look, I wouldn't hazard a guess as to when the economy would rebound fully because COVID's over. I think we all hope and pray that COVID's over tomorrow, that somebody from any country in the world, gets up tomorrow and says, hey, I found a cure. You just need to, inject saline and you're fine, right? That would be lovely. But obviously, I don't know. I think that medical research and vaccines do take a lot of time. I'm not sure that we'll necessarily see one at the time frames that world politicians, not just yours, but around the world, are actually suggesting. Certainly we didn't see it in the Spanish flu. I don't think we saw a vaccine for SARS or MERS or anything like that. These things just kind of went away a little bit, or mostly. So yeah, I'm not entirely confident of that, but I do think the world will start to open up. When it does, I actually think you're going to see a lot of money rush out of tech and go into other assets.
Oh, really?
I think that's.
No, hang on. Let me drill down. Why do you think that is? Because tech has really been. Tech is almost tech has been a tease. Sometimes it's really, really sexy, and then other times It's like, oh my God, stay away. It's a monster of an investment, like Halloween. So why do you say that about tech?
So there's been a lot more money that's been available in the wider economy, and
Right.
that's been largely as a result of the Fed increasing the money supply,
That's right.
which up until now has kind of been my sort of preference. I think that monetarist theory is better than fiscal theory under most circumstances. This is an exception. So what you've actually seen, I think a lot of this actually came about because of some of Milton Friedman's, comments and blaming the Fed for the Great Depression. Ben Bernanke obviously talked about him being correct about this, and so I think the Fed has gone more towards the path of look, when we have a crisis, we just increase the monetary supply.
Yeah. Actually, on that point, I'm amazed because the amount that they've expanded the monetary policy is just unheard of. And I think you're absolutely right about Bernanke and what they're doing now. But I'm sorry, go ahead.
Yeah. So what I think you're actually, I think you've kind of got a double whammy, because what would ordinarily happen is you never go all one way or all the other way. But in this particular environment, although Donald Trump has actually spent money on a lot of other things, he hasn't gone on the same sorts of spending levels or fiscal intervention levels by increasing government spending that perhaps other presidents would have. So what you've had is you've had an increase in the monetary supply without that being absorbed by government spending. And so that a lot of that money, in my opinion, has then gone into the markets. Now, obviously, our hospitality sectors are struggling. Our entertainment sectors are struggling. As you said at the beginning of the show, Disney's laid off a whole heap of their employees. The airline sector is struggling. Shopping centers presumably are struggling. All of those things are struggling. So I think that same question as I sort of said to you before, when you profit take, where do you put the money? So right now, where do you put the money? And I think that the one sector of the market that's actually doing pretty well is the tech sector, because people are using Zoom, they're using their computers more, they're using, all the technology. Amazon's being used more, Facebook's being used more, etc. So you're actually seeing a lot more users. But once things start to stabilize and people start going back to work, and the kids start going back to school, and the young people start going back to college, that sort of stuff, I think you're going to see people that are not using Amazon as much. I signed up for an Amazon Prime account for the first time this year, and I've gone on my shopping spree and bought all this crap that I don't need. And, I can't imagine. I mean, I probably will, because I had some shares in Amazon. I made a bit of money, and it's just one of my rules that I just keep subscribing to services where the stuff I've made money out of. But for most people, I think they can look at their Amazon Prime account and go, do I still need this? Do I still need to have a Netflix and a Roku account? And, people have subscribed to multiple of these things. I think a lot of these people are going to start to unsubscribe from that. And also just a very plain and simple, okay, do I need to have all my money in tech, or should I now set to rotate out and think, hey, the hospitality industry, hotels and that sort of stuff, I think they're going to go back up. The big companies that own all the casinos in Vegas, I think they're going to go back up. It's that sort of thing that I think would come into play. But just looking longer term, I do think that once COVID has finished, we will see a very, very fast and very dramatic recovery under any government leadership. I don't think it would matter who the political party is. But I think that there's going to be some damage that's been done, but I don't think that that's not damage that can't be rectified or made up by new people coming in. So what you might see, if I can just reach this quick point, what you might see is a lot of millennials have felt in a lot of wealthy Western countries that they've been basically locked out of the market because prices have been so high. There's been older people that have owned these businesses for 50 years that weren't prepared to sell, that sort of stuff. And a lot of those people will be ready to sell, or have sold, or have just simply shut down. That, I think, will give a lot of opportunity for entrepreneurial millennials to just jump into the market in small business and set up their own coffee shop or set up their own cafe and that sort of thing.
Okay, well, and you raise a point, and that's what I actually wanted to get to, and I'm glad we're going in the same direction, and that is this, that I characterize it as, damage, and maybe that's not the correct term. And then we looked at the same issue, and that is how the millennials are going to react when COVID is stabilized? What's their approach to the market? Now, you were citing the fact that you believe that they may be optimistic because they'll be able to finally, you think, be stabilized and then want to jump into the market. I guess my question is, with the millennials, because we have to look at them in terms of their entire economic experience so far, what they have learned and what's in their brain, well, their historical economic past. The job market has been unstable, marked by significant changes, and then into the gig economy where you're essentially on your own. The housing market has been so, well, out of reach for them. They found themselves economically disadvantaged and living back with their parents. They then found that even their jobs, even the middle class, the higher income ones coming out of the professional schools, started losing their jobs during COVID. It's been a real scramble. Now, my question is will that affect their psyche? And by way of comparison, after the Great Depression, the experience of the American people during the Great Depression, and then then the war, World War II, when they came out of it, they were substantially more conservative when they approached the market because they were concerned, and that generation was constantly preparing for a time when there wasn't nothing. Now, I said earlier damage. I'm asking, I think that's the wrong term, and that's my fault. Do you think that there's going to be a cultural, psychological shift when the millennials start coming into the market, so that rather than trying to get it all at once, they're going to try to be more conservative and safer, as opposed to just jumping in and having the good times roll again? What do you think about that kind of view, Shaquille?
Look, I think it's interesting because I'm born in December of 1983. So depending on where you do the cutoff, I'm either the very end of Gen X or I'm at the very beginning of the millennials.
No, you're clearly my generation. You're Gen X. I have a sister who was born in '73 as well, and you're probably.
Well, I read a very interesting thing once upon a time. They talked about there being a micro generation between the Gen Xers and millennials, which was from like 77 to 83, and I think that actually does make a lot of sense. But look, I think with the millennials, it depends on where they are. If the millennials in their 30s, by now they've kind of got their act together. You know, they've gone to college, they've drunk beer for years, you know, got themselves through a degree, got into a career, or if they've gone into trade, you know, they've honed in their trade, that sort of stuff. So I think that by now a lot of them are married, they're having children, or they've got children, they've put down a deposit on their first house. You know, they're kind of a bit older now. So some of them will be interested, I think, in taking some risks and having a business or having something on the side. But just to talk about becoming more conservative. So the millennials in the United States and Canada obviously had a much tougher time of it than what the millennials in Australia had. Because millennials in Australia and New Zealand, we didn't really experience the Great Recession that you guys did, because our markets actually did quite well during that period of time. And that was a lot of that had to do with the fact that our currency dropped. And because our currency dropped, being a mineral exporting country, and New Zealand being an agricultural exporting country, it made us more attractive. So a lot of international money rushed in, and it really propped our markets up. So millennials here didn't really struggle for jobs. They are beginning to now, and they have been for the last couple of years. But I think that what will be very interesting to see is actually the Gen Zs. So the kids that are just coming out of high school at the moment. You know, I think you guys graduate halfway in the middle of the year, whereas we graduate at the end of the year. So I think that your Gen Zs, that are the ones that are about to graduate or maybe have just recently graduated, these kids are, 17, 18, 19 years old. These kids have sort of gone through the hardship of 2008. I mean, that was all they've known for a lot of these kids. You'll graduate high school next year. Yeah. You were 5 years old when that hit, and you've kind of known just that for your life.
That's right.
So I do actually think you're already beginning to see them become a bit more conservative and become a little bit more watchful over how they spend their money. And they're not quite like the millennials and even the last part of my generation were, where, hey, that guy's got a nice car, I've got to go buy a new car as well. I think the Gen Zs are a little bit more conservative because they haven't had it. They haven't been able to have that, a lot of them. They've really struggled. And so, look, again, I think in the aftermath of the Great Depression, there were more millionaires made than at any other time in American history. So I do think that there's that potential. And it's not just because all the people at the top just get richer. I think it's a lot of people that grab hold of opportunities and go, right, I'm going to do this. And so if they study right, especially if they get some financial literacy and they learn how to, manage their money reasonably well and that sort of stuff, I think you're going to see the Gen Zs do everybody very proud.
Right, because it's really interesting. And then I guess the other thing is that, and it's something that we seldom talk about. It's the generation before us. I know you're at the tail end of Generation X. I'm kind of in the middle. But those that are like, 10 years ahead of me that, are on the cusp of retiring, the last vestiges of the baby boomers, I would say, which is the prior generation. And I'm not sure how they are going to sit in the market, because some of them maybe have had to go back and get jobs because they weren't able to repair damage that was done in the past. And it seems that they become a much more mobile generation, both in jobs and creativity, and also in lifestyles, downsizing and things of that nature. Do you see any potential impact of them with regard, as a group, on the markets and investing? Because before they were just taught, invest in the market, and then after you're done, you'll have your stuff. But I'm listening to Shaquille. And don't mind me. I just think your brain is fantastic, and so I'm trying to take all the advantage I can of it while I have it. So
absolutely. And look, these are just my opinions, and I don't think there's any right or wrong answers here. They're just my opinions and my personal observations. Look, the baby boomers predominantly were, born around sort of the end of World War II or shortly thereafter, through the 50s. And, look, they had it pretty good, right? It was good and it wasn't, right? So I think what was very good about them is they tended to have a lot of brothers and sisters. You saw a lot of families where they had, 5, 6 kids or more, and they were all equally poor, and I think that my generation can certainly, relate to the, grandparents that are going, when I was your age, I had to eat bread and drippings and that sort of stuff for lunch. I think that what's actually been good for them is that they all came through the same kind of poverty, for lack of better words, but they all had a pretty good run when it came to their teen years. From what I hear, the 60s sounds like a lot of fun with sex, drugs, and rock and roll. So they had a good time, but they also had jobs to go to, and they sort of got to get into a lot of things. And of course, they now are at the very top of their fields.
Right? That's right.
But as they retire, because there is a lot of them, as they retire, that then leaves a lot of room for younger people to move into those roles. And I think that depends on where they are. If they have relied on Social Security benefits, that's going to be a little bit tough, unfortunately. And a lot of them have, in good faith, they've paid their taxes their whole lives, and the government over successive generations has basically broken their promise because they haven't managed the money very well, and a lot of people are going to find themselves struggling. But for those people that have done relatively well, that have had their money in the markets and have some nice money to retire on, I think you're going to see a lot of people who are, they're baby boomers, they're retiring, they want to travel, they want to go and see their grandchildren, they want to go on holidays, and, they want to go to the bar and have a few drinks and go out and, go to nice restaurants and that sort of stuff. And they deserve to be able to do that. But that's also going to spark some new economic activity, because you're going to have money, the saved money, and people that might have 3 or 4 investment properties that start to sell those investment properties or sell their main house and downsize. They're going to have a lot more money, and that money is now going to start getting spent. And that's why I'm saying that I think that by the time COVID's over, a lot of those people will say, you know what, I don't need to work anymore. I've had my business for 30 years. I'm going to give it to my kids, and I'm going to retire. And I think that would be very good for the market, and I hope the baby boomers weather this storm well.
Okay. Well, Shaquille, all in all, I mean, that's a very optimistic outlook. With all 3 generations and for where we're going, obviously given where we're starting. And if I didn't know that you were an Australian, I'd say that you were an American, because we certainly are more optimistic because we are the #1 economy in the world. But listen, well, all that counts is the moment. And so today is the moment, tomorrow's the moment, and until somebody else grabs the crown, then we are it. However, with that having been said, we certainly want to jointly, both Shaquille and I, apologize on behalf of IBM TV for the technical difficulties that Sasha has experienced today. This is Investments with Sasha, and normally Shaquille and I are simply the mentees learning from Sasha, but today Shaquille, admirable step in, and we welcome all of you. We hope that you learned something. And Sasha, we know you're out there. We hope that we've taken quality care of your show and your audience and lived up to your expectations. Shaquille, do you have any concluding thoughts as we conclude this co-hosting of Sasha's investment?
Well, I can't talk about Canada in quite the way Sasha does, but I will certainly say for those of you that tune in, you know that Sasha often talks about options and perhaps selling options over stock you already have and those sorts of things. I would just try and reiterate what I said before. You know, there's lots of books out there. You know, you can go to the library, you can get them on Kindle for free. You know, those sorts of things. You know, read up on these sorts of things. Financial literacy is something that I personally love to focus on for our young people. It's really important, but it's not just for young people. It's for you as well. It's for older people who want to supplement their income as they're retiring. It's for people that, hey, look, you know, if you're working and you can just afford to spend a couple of hours a week looking after your portfolio, you might be able to make a few $100s extra a week or even a month, you know, and that can add up. So I certainly would pay attention to a lot of those things.
Okay. Well, there we have it. That is Investments with Sasha for this Wednesday. I am honored, as I always am, and Mr. Latimer knows exactly how I care and appreciate his witty takes on life, his insights. We've had quite the conversations over the time that we've known each other. So thank you, Shaquille. It's always a pleasure to spend time with you. And so on behalf of Sasha Starr and Shaquille Latimer, I'm Bill Trezmont, and this has been Investing with Sasha. We look forward to seeing you next week, and thank you for tuning in. Shaquille?
We have to say it together. Good morning, good afternoon, and good night.
Thank you. All right.